My name is Mike Porter, I'm Principal with McBee Associates, and we moderate this great panel we have here today to talk about the industry trends and where we believe the market's going to be going. We had a lot of lively discussion over the last few months in this panel, talking about where we are, and especially with some of the transactions that are taking place, and we've all heard about through the last couple of sessions, especially this morning. There's a lot of diverse thoughts and where we're going to be going. So what I'm going to do is, in this session, I'm going to let the group introduce themselves. We're going to go through, we have 5 topics we'd like to cover. We're going to have lively discussion, but at some point we're going to go through and I'm going to cut topics very, very short. We're going to do about 10 minutes per topic and then keep moving through. At the end, we're going to actually go through, as we have an hour. There's 15 minutes between now and the lunch break, so we're going to allow questions at the end at that point. But I'm going to let the group go through and introduce themselves.
My name is Jason Ficken, co-founder of best way to describe it would be a mergers and acquisition shop focused exclusively on healthcare, and I'm excited to meet you today, so we're looking forward to the dialogue.
Hi, I'm Claudia Gordon, and I'm with Healthcare Finance Group. We are a lender to the space, primarily senior debt, and we only do healthcare.
My name is Chris Hendrickson, and I'm with Ziegler and Company. We are about a 110-year-old firm, largely focused on the senior living practice and all of our home and community-based services.
I'm Ron Malone. I'm a partner in Transpirus, which is a firm focused on outsourced coding, RCM, and advisory services for this space.
I'm Les Levinson. I co-head the healthcare transactional practice for Robinson & Cole. We're a mid-level multi-city law office, and I've been in the home care and hospice space for 25 years, probably. So know a lot of the folks in the audience and everybody on this panel.
Great.
So Mike, I just want to, so Ron, you left something out in your introduction. I think there's a lot of
Well, why don't you finish it?
I know there's some people here for the first time. I don't think everybody knows that you're the former CEO of Medicine.
I worked for many years with Gentiva, which is, I guess maybe today or eminently part of Kindle. Thanks.
So what we're going to do is, like you ask the questions, like I said, we're going to give each panelist about 3 to 5 minutes to talk on and answer the question, and then open the discussion along the panel. So I'm going to start with Jason. What are your thoughts on financing options for home care and hospice transactions, and how have they changed, and how will they continue to change over the next 24 months?
That wasn't the question that you had given me.
You don't like that one.
Actually, it's a beautiful thing for me. They put the most verbose person first, because then I can say everything that they had intended to say, and you can see a pretty hostile outbreak here. But I will assure my panelists that I won't do that. Look, I think it's a very interesting question that you ask, and one that was truly assigned to me, but I hope my esteemed panelists jump in. It's difficult to make a real assessment, not only on where we've been, but where we're headed from a financial perspective in the marketplace, especially when I think about the disparity of the different businesses that we have sitting in here. I mean, obviously, we're all here focused on home-based care, whatever that means today. It will mean something very different tomorrow, but the subtleties that are associated with that really drive not only the financing solutions that exist in the marketplace, but also the valuations that play out. And I can't recall, although Marsha's been incredibly vocal, I don't know if it was her or someone else that was making some great comments early on, challenging the panels. And the one thing I want to ask this entire audience to do over the course of the next hour is don't have us talk at you. I know we're reserving time at the end for questions, but raise your hands. I mean, we're here to try to understand and address questions and concerns that you guys have in the audience. So, although we have prepared remarks, please get those hands up, because right now my answers will vary depending on specific subtleties. Are you a home health operator or a hospice operator? Are you an integrated provider? Do you get reimbursed through Medicare or Medicaid? Are you an integrated player that has skilled operations and you're moving into home health, or vice versa along the continuum? So many of our answers are specific to the subsector within home health that you actually operate on a daily basis. So please raise those hands up. The second thought I'd leave you with is really, it's a dynamic time in the marketplace. I see a number of lenders in the audience that we've dealt with before. I can't call you out because Ms. Gordon will shoot me sitting right next to her, so I'll only reference HFG. But the reality is we worked very closely with them on a recent transaction, and I was surprised by the amount of leverage and the risk taking, although prudent, that they were willing to to underwrite our transaction with. It has really opened up the world for transactions in this marketplace, and it's driving valuations to unprecedented levels. But what I want to leave you with is this. The marketplace right now, because of the expansions that exist, we find ourselves in a situation where you don't have to be Gentiva or Kindred to be able to access debt. You don't have to be those organizations to access equity. The most recent process that we ran, which Claudia was involved in, we had 3 private equity groups that outbid all of the strategics. And so I know there was some dismay in an earlier panel that we had saying, well, what are you big strategics going to do? And there seems to be almost a disenchantment that exists between, I'll describe it as the haves and the have-nots. And the one thing I want to leave you guys with right now is that we find ourselves in a position where every single operator in this room has access to capital. And you don't have to try to determine, do I just want to sell? That's not your only option that exists out there. So as we delve into more and more anecdotes and try to make this real, the thought I want to leave you with is there is more capital than I've ever seen in the 20 years that I've been in the healthcare-oriented M&A market right now, specifically trying to put capital to work in subsectors of healthcare that sit at that transformative position, which is exactly where you all are as operators and providers.
Yeah, and I would add to Jason's point, the delineation of home health and hospice and personal care, it's going through a very transformative event, and the level of differentiation, I think, is meaningful as lenders are also looking at how they view companies and the amount of leverage and sort of where they may migrate to in the continuum of care, because as you'll learn more as we speak today, there is incredible transformation going on across the health systems. And I think a lot of us are very focused right now on breaking down some of those barriers and actually creating fundamental changes in models. And what I've seen in some recent activity we've had is those that are fundamentally different or approaching the world in a more unique place are getting incredible appetite, both from sponsors, strategics, as well as the lenders, of course.
And I should just underline that there really is, I won't say enormous amount of capital available, but there certainly is sufficient capital available. The lenders are hungry for business, looking for options, looking to support operations who are deserving prudently. And it doesn't always have to involve an equity sponsor. An old-fashioned go-get a loan is still very alive and well. And I have to admit, we're not the only ones who can do that, although we're clearly the best. But really, there is more capital available now than there has been in a long time. There is an expectation, I think, on the part of a lot of people that rates are going up. So it's probably a good time.
Yeah, to that point, I mean, how much of this difference macro and how much is industry driven in the availability of capital? And if you were going to forecast into 15 or 16, where would you think that would go?
Up.
Well, and look, it's a very interesting question, and I think if we all would roll back the clock 24 months ago, we all would have presumed that we wouldn't have just hit an all-time low on the 30-year treasury. Literally weeks ago, not 2 years ago, when we were talking about that. So I couldn't agree and respect your assessment more, but I will tell you this, from our perspective, and keep in mind, as an investment banker, I get paid to transact, right? So this is counter to everything that my firm believes in, right? Which is get you guys to transact. At the end of the day, we don't think rates are going higher, and I'll tell you this, I'm doing this with my own home mortgage. We don't think rates are going to rise until the 2016 election, if not after. So although I think time is of the essence, the real question that Les asked is critical, which is there's a juxtaposition between where the macroeconomic or exogenous factors exist, where are interest rates? Because at the end of the day, where lenders are getting capital dictates where private equity firms can underwrite their transactions, but dictates where the strategics can come in and play. But our assessment is that from a macro perspective, it's not going anywhere, at least through the next election cycle. More importantly, where is the industry? And I think that's something that you all are significantly better positioned than answer than I can. Although I focus exclusively on healthcare, you know more about the day-to-day operating issues and obstacles that you guys have in your pinkies than I ever will. But I will tell you, when we talk to operators in this space, they're scared. And that's okay to be scared. Sometimes that fear, that apprehension, that nervousness drives innovation. But what we're trying to communicate, what I really want you guys to take away from this is, yeah, there are exogenous factors that you can't control, but there's some very specific factors that you as operators can influence that will drive better outcomes. And I think, you were touching on that very specifically, Chris, in terms of what goes on in the marketplace and what the marketplace is receptive to.
The one thing I think really important to add into this conversation is that the calls I'm getting from private equity right now are asking more about management teams and making a decision on which management team to pick, more importantly than who maybe have the most money or what's there. They're going to take and they may pay more for an organization and a higher multiple for the management team than others. And I think that's a really important piece to add into this mix. So it really, when you look at these.
It's not only on the equity side. We pay a lot of attention to management teams. It's a very important factor.
And there's still, I mean, the other thing I think we're facing as a lot of the management teams are getting older, people are retiring, we're seeing more and more of that happen. There's still a lack of leadership in younger management teams coming up. And you start to see some of this integration, and I think a point was made in the earlier session when you listened about, well, there's going to be a lot less agencies, but the people that are managing smaller agencies may be managing larger as these acquisitions take place. And you look at what took place on some of the prior transactions, you look at when the prior Gentiva transactions, when Hardin was acquired, a lot of that management team dispersed, and now you're going to see as these couple of transactions take place right now, with the Kindred Gentiva transaction closing right now, you're going to see some of that Gentiva management team will disperse into other organizations, and I think you'll see the lenders in the private equity space grab those management teams and say, let's buy something and put them in charge of those organizations. So to move to the next question, someone addressed this one to Ron. What do you feel the deal prices will be? Where do you think deal valuations will go in 2015 and 2016?
Well, I think I'd answer it two ways. One is I say, everything I see would say up. And then I want what a good friend or lawyer would say, but also depends. It depends upon the size and the quality of the asset. But if I looked at what the negative questions are, what causes transactions to fall apart, what I have seen personally is concerns about leadership teams being tapped out, not having the runway or maybe not having the experience to grow. Having maybe wrung out the margins a little bit too much and not invested in teams that can grow. And the second thing that I have seen, I've seen that close and personal, transactions falling apart because they weren't viewed as sustainable, because something happened in due diligence that exposed just a nerve about something being a little bit too good to be true. And once that fear is put into the buyer's head, it can really unravel. So I think I would say if you're talking about quality assets with regional density, good leadership teams where, for instance, if in case of a for-profit entity, if the leader or the founder is going to maybe go away, what's the strength of that group, and sort of how do we get their head in the game? Those are all really important factors, and if they align, and say you continue to see, see the multiples, it's hard to say. I don't just say that they'll go up, but they'll be at unusually, against historical precedent, they'll be pretty high levels.
So I'm going to go back to, I can take a stand on this issue. I do think that multiples are stable, and they're going to continue to be stable. I think that's a trend we haven't necessarily seen in the past. I also think that we do have a little bit of a tale of two cities, where you have a bifurcated market. We've again seen that historically, where certain companies of certain size or penetration are going to command a multiple that's lower than an asset that's maybe a little bit more developed because it has a larger footprint. So I don't think that trend is necessarily going to change. I do think we are seeing, and this probably goes into the question I think I'm going to get, is that we're seeing processes that are more robust and more widespread. I think that has to do with a lot of factors, one of which is that there's a lot of interest in the industry. Sometimes there's almost a little bit of a herd mentality. There are people looking at things and going, these guys are investing over here, why am I not looking, at that particular asset? the end of the day, you have to have capital to consummate transactions. And if you're competing for that capital with other industries or other subsectors, that makes it a little bit more challenging. So I think you have a nice perfect storm of stable valuations, you have quality companies, you have a lot of dynamics that are going on, in the marketplace, and you have capital that's accessible and affordable.
And I would also add, in regards to management teams, I think strategic vision has become a big component in how companies are being valued. Obviously, any strategic vision has to be reachable, and there's got to be a pathway to accomplish that strategic vision. But I'm seeing a lot of people get behind management teams, or even sometimes a single leader who's got a very thoughtful strategic vision, who may be embracing change while others may be fearing from it. But where I've seen very healthy processes and lots of respect garnered is parties that are really looking at the world in a different light and willing to take a chance to work differently, with either managed care or hospital systems or senior living, or even other ancillary providers who seem to be gravitating towards this space because it's getting so much attention right now.
What is the group's feeling when you look at deal prices on the smaller transactions versus the larger ones? I know there was, again, conversation this morning on there's this huge group of agencies that are smaller than the group that's here. What is the group's feeling on the transaction prices of those smaller deals and the multiples related to those?
Well, given we focus on the middle market, and I don't know if Mark's in the audience, we don't bank Addis. If he wants me to help him, I'm more than happy to do that. But the simple reality is that we were very focused on the middle market. I saw an interesting statistic, although I don't know if I believe it, that said if you have more than $5 million as a home health or home care-based operator, you're in the top 5% of operators out there. It screams fragmentation. It also screams consolidation and all the other four-letter words that people kind of throw out about this industry. But I would really want to implore upon everyone to recognize that the opportunity set is pretty narrow for the big guys. There's only so many Health South, Gentiva, Kindred, Hardin opportunities, Guardian, whatever it may be, opportunities out there. And yes, it is theoretically easier to elephant hunt and then integrate those businesses in and obtain real scale. And public markets sure love those stories, but at least for me, that's not my everyday reality. So fortunately, I think in answer to your question, we're seeing valuation multiples at pretty high levels. I dare say stratospheric levels for the smaller opportunities. Partially because of the access to capital that they have, and partially to what Chris was touching on. We have some very innovative, integrated operations and solution sets that exist out there. But you just have to look in the marketplace, guys, and see that things fundamentally change. I think if you were present at this event or the JP Morgan Healthcare Conference 2 years ago, you would have headed in thinking that if I had a Medicaid-oriented, non-skilled home health business, my multiple was going to be 3 or 4 times whatever your cash flow is. You'll hear us talk about multiples. And really almost an untransactable type scenario. When I emerged from that conference, and I think it was in early 2013, Medicaid home health went from being the redheaded stepchild to the preferred solution set if you were in the right geographies. We were in market, and a northeastern-based operator had $7-ish million of EBITDA, so still relatively small compared to the big guys. And we had 3 private equity firms bidding on that transaction at multiples significantly higher than any of the strategics ever contemplated paying. So my assessment, just with anecdotal evidence, is it is an incredibly robust time to be a smaller participant in the marketplace.
My assessment would be the PE firms aren't very smart.
It's, look, there are, it's interesting you say that, because I think there are 2, maybe there are some private equity guys in here. I've seen the Sharks circular tank in here. But, and Ben, if he's in here, he's had some great exits, so you're not allowed to stand up, or maybe you have more credibility because of that. There are polarizing views on private equity, there's no doubt. And sir, I don't know if you're an operator in the space, but one thing that I know we wrestle with when we bring a company to market is exactly that. The private equity firms, the strategic buyers want to know, why are you selling? And the art in all of this is to convince them that there remains significant upside in your core business, and that's what the private equity firms are betting on. But you know, if the private equity guys aren't very smart, the billions and billions of dollars of endowment firms that are backing those private equities are even less intelligent, in my opinion.
But frankly, most private equity firms are smart, but you'll never lose money, betting against their ability to see anything with any size as a platform. So sometimes I see very, very small, and you also have this added dynamic of an enormous amount of uninvested capital they have, equity they're trying to put to work. There are only so many places they can go. They do operate often with a herd mentality. So I said, whether it makes any sense to you or not, I'll assure you they have convinced themselves. And I still believe, notwithstanding, I think you're exactly right about there, you know, it may be fun to walk around with a big gun, but it's not going to be very effective if there are no elements. And there are just so many limited numbers. There'll always be, I think, let's say for the foreseeable future, there'll be a need to allow smaller firms to aggregate, because it's much better for a company like a Gentiva, Kindred, those types of larger players to buy $200, $300, $400, $500, $600 million of revenue. They can do that much more efficiently and let somebody else do it. And they're generally, they don't care that somebody else made money along the way.
But I would be careful when we're talking about size. You have the very big ones that we all, I think, can identify. You have the middle market, which is a bit of an amorphous size range. People tend to define that in a wide variety of ways. And when you get to the lower end of the middle market, if you are at a $5 million EBITDA or under, then I think the access, certainly the private equity guys become a little less interested because it's a lot of work. You don't have the same emphasis and energy around those firms. And so for those, I think finding a buddy, getting together sort of as a merger or a joint venture, whatever form, and I know we're going to get to that, that is an interesting option so that you can get to a little bit bigger size and then garner the interest of some of the more active players. That being said, there is still money available for the smaller players. I mean, you know, not really a teeny tiny, you know, $5 million revenue company, but for the smaller players, there's still access to capital. There is still debt financing that is available at reasonable pricing. So, you know, even before you're maybe ready to go or want to go, sir, to the private equity group, you can still access enough capital to continue to grow.
Yeah, I think we're all saying the same thing, just in a little bit different and nuanced way. I think we have a strong market. I think we have a much more vibrant market than we did 2 or 3 years ago. I do believe that there is still more bifurcation. You may be able to execute a transaction today that you couldn't execute even at the lower end of the market a couple of years ago because of the rising tide is lifting those boats. But I do think you shouldn't necessarily expect you're going to get the same valuation that a larger company is going to get. That's maybe gone through some of the things that we've heard a lot of talk about this morning about becoming efficient and putting systems in and making sure that your management bandwidth is stronger. So I think the positive takeaway is that there's a good market, and on a macro level, on an industry level, there's interest.
So next question is going to go to Les, let him continue. So on this area, will new players continue to enter the market, and as we can see consolidations and what types of things you see coming?
Well, I think we heard a lot about that this morning, and I think it's going to be a thing we're going to continue to hear a lot about. We are clearly seeing a broader-based interest in the space. The deals that everybody talks about, the Kindred Gentiva deal, I find that particularly fascinating because it was a hostile deal, and we just haven't seen any hostile deals in this space, and the circumstances have to be right for that. But I think you had a pretty persistent buyer, and continue to work on that asset for a while. Not far behind it was the Health South, Encompass transaction. We spent a little time talking about private equity. I think a few years ago, private equity was a little less interested in this space. I think that there's clearly a lot of interest in this space.
Nordic Automobile Metro. There are other firms that are looking around, and I certainly think in the next quarter or so, you're going to see more announced transactions. Last week, there were a number of other deals that were announced kind of in the mid to lower market range, 6 to 10 million kind of transactions. So I think that there's a lot of interest from a variety of players. I think the insurance industry hasn't sort of started to really rumble down the road on this. I think you're going to see some playing going on here. It was interesting, the panel this morning, where some of the participants were interested more in just straight collaboration. I think other people are interested in owning the asset. I think the dust hasn't settled on that, but all of that just creates buzz and it creates interest in the space, and I think that's, that's healthy. There's a lot of talk and continuing dynamics about collaborations, whether they're traditional ACOs or ACO lights or issues or, whatever you want to call them, but the insurance industry, clearly in the commercial pay, has been driving this space for 2-3 years and forming a lot of collaborations and alternative opportunities. So I think, stay tuned. We're going to see a lot now.